Today is this is the evening of September 25th, 2022, and I have been studying the market for a while, and unless I become deeply involved in what's involved in this market, it is difficult for me to. It's difficult for me to uh, trade properly. So what seems to happen is one thing for sure is that the market moves in cycles. So what seems to happen is that if the market is moving sideways, the economy, wow, it's so it's fascinating how the market is moving. It's incredibly fascinating. The reason why it's incredibly fascinating is the fact that the market on a bigger picture moves in trends. So the Dow Jones, if I were to just look at the Dow Jones, what Dow Jones will do is that on a periodic basis, it gets into a situation where it moves up for a long stretch of time, and it has been doing that for since the birth of the Wall Street. And what seems to be occurring is that so there, if I were to expand out in a longer time frame, it creates a long trend, a focal point of understanding. The primary objective understanding on a larger picture time frame is understanding the characteristics of the market. And the market has the ability to establish a certain directional trend, which impacts and the fact that individual stocks individual stocks make up the larger picture of the stock of the indices. One of the things that adds up to an indice are numerous other stocks, and numerous other stocks go in a trend where the economy is based on certain criterias. And one of the mechanisms that the federal government has in its arsenal is to control the behavior of the market based on the raising and lowering of the interest rates. It is able to control what happens, because the fundamental idea is that lending is one of the most powerful mechanisms that controls the behavior of the market. It causes the economy to heat up, and it causes the economy to slow down. And it's as though, because what happens is that vast majority of individuals want to make money, and one of the easiest ways to make money is to place money into a higher interest bearing accounts. And when interest rate is raised, people will take the unsafe route that exists in the stock market into a interest bearing accounts. And that means that the stock market accounts are depreciating in value. And when that happens, also what occurs is that when the price is high, it's very, very complicated how these things are intricately interweaved. So how does the how are earnings impacted by the raising of the interest rates? The raising of the interest rates how is that impacting companies like Costco? How is that impacting companies like Amazon? How is it impacting? So, what is the direct link? What is the direct link with the federal government raising interest rate? What would cause that? Why would consumers see when a stock goes down? It is because consumers are reducing its consumption of the particular stock. That's what it is. But how does raising interest rate reduce the consumption? How? It seems to me if the price is higher, then there would be a less amount of expenditure. So I don't see a correlation between the consumption, consumer consumption, that increase the price of the stock, and the increase in the interest rate. How is that related? How is that related also to the oil price? It seems like the big pictures, big items that impact the stock market is the oil price, and government has the ability to lower the oil price by either flooding the market with the reserves. That's one way of impacting it to adjust the economy. That's fascinating, isn't it? The second part is raising the interest rate such that the consumer price can be lowered. How is that related? How is CPI numbers were quite high? So how does so people will save money. People will start to save money. That seems the biggest factor. That seems to be so consumers will spend less if interest rates are higher, and borrowing rates are higher. And it seems to me that the credit cards that are issued and the loans that are used to consume, and the bigger things like consuming large automobiles, and these people who work in the industry, it's fascinating how these are interweaving into how the economy is impacted. This is a global economic analysis. So essentially what happens, essentially looking at a big picture. We're looking at a big picture. The big picture is this: the federal government is single-handedly able to control inflation. That inflation means increasing the interest rate. When the interest rate is increased, what we'll do is it'll cause consumers to consume less. And the reason is this: people will be less able to buy houses and big ticket items. And these big ticket items are fueling the economy. And when that is throttled down, and as well as credit cards interest rates become higher, people tend to use less. People tend to spend less. And when people tend to spend less, it causes the market to decline, because each individual stocks are based on consumers spending, and consumer spending is reducing, which causes the stock market to decrease. And as well as when that occurs, the flood of money leaving the stock market into the bond market causes because when the interest rate is raised, the bond interest rate becomes higher. And what that happens, it's a double whammy on the stock market. And therefore, the only bullish scenario at this point is the innovation that the market provides, the individual stocks provides, in order for each of the sectors or certain individual stocks to increase in value. And therefore, that is the connection between the interest rate that the federal government has. That is why the world is listening to what the federal government is federal government is saying about the market, what they're going to do with the interest rate, and what they're going to do, and how the government is attempting to stabilize the market in order to stave off a catastrophic event. And so that is the main reason why it is in the best interest of the United States federal government to implement these policies, and make the market healthy. That's what's happening.